ratio is a key liquidity metric that tells us how well a company can cover its short-term liability with its short-term assets. It's calculated by dividing current assets by current liabilities. A ratio above 1 generally indicates good financial health, as it shows the company has more assets than liabilities. The current ratio measures a company's ability to pay short-term liabilities with its short-term assets. A ratio above 1 suggests financial stability. Susu Teleport Berhad has a current ratio of 1.27, meaning it has just enough assets to cover liabilities, indicating stability but a tighter margin. In summary, the current ratio assesses a company's ability to cover short-term liabilities with short-term assets. Susu Teleport Berhad's ratio of 1.27 indicates financial stability but with a narrow safety margin.
Next, I'm gonna analyzing one of its key financial metric, which is profit margin. The profit margin of Susu Teleport Berhad tells us how much profit a company earns for every ringgit of sales. The formula is simple: divide the net income by the net sale, then multiply by 100 to get the percentage. Let's make a closer look at the numbers of Susu Teleport Berhad. The company reported a net income of 9,654,890 ringgit and net sale 31,675,000 ringgit. When we calculate, this means that Susu Teleport Berhad earns a profit of 30-48% for every ringgit of sale. This impressive margin reflects the company's efficiency in managing costs and converting sales into profit.
Next, let's take a closer look at the financial performance of Susu Teleport. With net sales recorded at 31.68 million ringgit and a gross profit of 16.3 million ringgit, the company has achieved a gross profit rate of 51.5%. Now, what does that mean? For every ringgit of revenue, more than 51 cents remain after covering production costs such as ingredients and packaging. This is a strong performance and indicates effective cost management. The remaining 48.5%, however, is spent on producing the product, showing that cost control is still critical as the business grows. With this solid foundation, Susu Teleport has room to reinvest in marketing, expand operation, and enhance profitability.
Then, debt to asset ratio of Susu Teleport. This ratio is a key financial metric that compares a company's liability to its total assets, providing insight into its financial risk. The debt to asset ratio is calculated by dividing total liabilities by total assets. A lower ratio indicates lower financial risk and a more conservative approach to debt. For Susu Teleport, the debt to asset ratio stands at 26%, with total liabilities of 12.57 million and total asset of 48.31 million. This ratio highlights the company's low reliance on debt and its strong financial position. In conclusion, Susu Teleport's low debt to asset ratio demonstrates a cautious approach to debt, minimizing financial risk and positioning the company of stability.
Return on asset (ROA) is a financial ratio that measures how efficiently a company uses its assets to generate profit. It shows how much profit a company can produce for every RM1 of assets it owns. The formula of return on asset is net income divided by average total assets. Return on asset or ROA measures how effectively a company uses its assets to generate profit. For Susu Teleport Berhad, the ROA is 22%, meaning the company earns RM22 cents for every RM1 of assets. This indicates that while the company is profitable, there is significant room for improvement in optimizing asset utilization. Strategies like cost reduction, improving operational efficiency, or better investment in high return assets could help boost this figure in the future.